Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates. 10-year note yields continue to climb, keeping the trend in place. We saw, yields touch a 3.5 high this week. We saw the 10-year note get sold off, yields kind of moving higher. Never really a fear of a pullback. I think we had one little head fake where we saw yields decline slightly, but certainly the trend has not been broken, and it seems to be leaning technically towards a trade towards 275 yield, and that certainly would play right into the hands of market expectations of policymakers and whatnot, that slow and steady move higher in yields, given what we're seeing out of the Fed, and certainly after what we saw for so many years on those uber low yield levels. And market volatility, while we are still within that trend, we aren't seeing market volatility decline. We actually saw it increase. We saw a pretty good sizable move higher in implied volatility from last week. However, there's always a however in there when you talk about volatility. We're at about the middle of the 8-month range. So while we are seeing a significant move higher, it only got us off the lows, and we're still within that really tight low range. So market's really not pricing in fear. We're not in that area yet where we say, wow, things are getting out of hand, out of control. I think the slow and steady move that we've seen from the 10-year note, going back to when we were talking about maybe that range at the end of 2017, that 230 to 250, which shifted to 240 to 260, and now seems to be shifting from 250 to 270. It's happening at a slow pace, and that's exactly what policymakers want. They don't want anything surprising, and that's why volatility has remained so low. There isn't a real fear that what's happening is going to throw the market off the tracks for a loop. Likewise, when you look at equities on all-time highs, why not be happy? Where's the fear in that? And I think lastly, if you look at FOMC next week, now this is a meeting that isn't expected to see a rate hike, and with Janet Yellen waving goodbye, that may be the focus. It's going to be more about outlook, and it's going to be more about expectations. However, I do believe that the Fed in their statement may address the yield curve, which despite the rise in yields in the 2-year and the 10-year, it remains on historic lows. The 10-year is still right around 55 basis points, same place it was a month ago, and despite the fact that we've seen the significant move higher in the back end of the curve. So I think right now that what we're seeing is the market's pricing in those short-term rate hikes, and the back end of the curve is just keeping up. So we haven't yet seen the curve steepen to suggest a lot of the uncertainty that's being priced into the future has been written off. So I think right now the Fed does have some explaining to do. How are they going to manage if the fact that if we do raise 2 more times this year and the status quo prevails, that you get that 2s10s trading at zero, with the idea that things are going great in the economy, but 10-year yields can't seem to muster up any sort of a rally beyond that of the 2 years. So I think that right now that is going to be a big question when we come to Janet FOMC. And if we don't get it then, we certainly will get it when Jerome Powell sits in front of Congress for the chairman's semi-annual testimony in February, or at the March policy meeting when he will give his first press conference. So a lot of questions out there about the yield curve still, despite the move in yields. But Treasury's looking very bearish here as yields continue to climb. Don't expect anything to change because of FOMC next week, but we may get some clarity. This is Todd Colvin coming to you from the floor of the CME Group.